Here is the number that the passive income space almost never leads with. To generate $4,000 per month in genuinely passive income from a dividend portfolio, money that arrives in your account every month without you doing anything, from quality Canadian dividend stocks paying an average 4% yield, you need approximately $1,200,000 invested, not $10,000, not $50,000, $1.2 million. $3,000 per month requires approximately $900,000. $2,000 per month requires $600,000. $1,000 per month, a number that sounds modest, requires $300,000. These are not pessimistic estimates. They are straightforward arithmetic. Monthly income target times 12 divided by yield equals required capital. At a 4% average dividend yield, a reasonable, sustainable figure for a quality Canadian dividend portfolio, the capital requirement is 25 times the annual income target. This video is not here to tell you passive income is a myth. It is real. Dividend investing is real. The compound curve is real. Building toward $300,000 or $600,000 or $1,200,000 inside a TFSA over a working life is real and achievable for many Canadians, but it requires capital. And capital requires either time or income. There is no version of this that involves a course, a system, a side hustle hack, or a lifestyle brand. It involves putting real money into real investments over real years and letting compounding do its work. This is the honest version. Starting now. Before the math, a taxonomy. Because passive income is one of the most abused terms in personal finance, and most things sold under that label are not actually passive. What genuine passive income is? Passive income is income that arrives without active, ongoing effort from the earner. The key words are ongoing. There may have been significant upfront effort or capital deployed. But once that is done, the income flows without requiring the earner's continued time. A dividend from a publicly traded stock is passive income. A bond coupon is passive income. A rental property managed by a property management company comes close. Though it requires periodic attention, it is closer to passive than active. What is commonly marketed as passive income but is not. Dropshipping requires active order management, supplier relationships, customer service, and ongoing marketing. It is a business, not passive. YouTube/content creation requires ongoing content production, editing, SEO management, and audience development. It is a part-time to full-time job, not passive. Selling online courses requires course creation, platform management, marketing, and customer support. The income may be somewhat residual, but the ongoing effort is real. Not truly passive. Affiliate marketing requires active content creation, SEO, audience building, and relationship maintenance. Not passive. Rental real estate, self-managed, requires tenant screening, maintenance coordination, rent collection, and lease management. It is active income with a flexible schedule. Only genuinely passive when professionally managed, at a cost that significantly reduces net yield. The honest spectrum, at one end, genuinely passive. Dividends from a stock portfolio, ETF distributions, GIC interest. Requires capital. Requires essentially zero ongoing effort after investment. In the middle, semi-passive. Rental property with management, royalties from a book or music catalog, certain licensing arrangements, requires periodic attention and upfront work, but less than a full-time job. At the other end, marketed as passive, actually active. Most online business models, content creation, e-commerce. These can be excellent income sources, but they are businesses, not passive income. Why this distinction matters? If you are building toward passive income, you need to know which category you are actually in. Building a YouTube channel is a legitimate and potentially lucrative career choice. But calling it passive income misrepresents what it actually involves and may lead you to underinvest in your actual business while waiting for the passive income that was never going to just arrive on its own. Let's run the real math on the most commonly discussed passive income streams, including the ones that actually are passive. So the comparison is honest. Option 1, dividend portfolio, genuinely passive. As established in the hook, $300,000 at 4% yield equals $12,000 per year, $1,000 per month. Capital requirement is the entire challenge. Once deployed, ongoing effort is essentially zero. Inside a TFSA, entirely tax-free. No tenant, no algorithm, no customer service, no maintenance. Just ownership of businesses that send you money. Option 2. HESA/GIC interest. Genuinely passive, lower return. At current rates of approximately 3.0% to 3.5%, a $300,000 HESA or GIC generates approximately $9,000 to $10,500 per year, $750 to $875 per month. Lower than dividends, but with no market risk and CDIC insured. The capital requirement is the same. The return is lower. Taxed as interest income at full marginal rate in a non-registered account. Significantly less tax efficient than dividends. Option 3, rental property income, semi-passive at best. As covered in the Dividends versus Real Estate videos framework, a $600,000 Toronto condo generating $2,500 per month in rent, managed professionally, produces approximately $600 per month in true net income after all costs. True net yield, approximately 1.2%, requiring $600,000 in deployed capital as a down payment on a much larger asset to generate $600 per month, plus ongoing landlord responsibilities even with management. Option 4, REITs, genuinely passive, real estate exposure without landlord role. A real estate investment trust is a publicly traded company that owns income-producing real estate, commercial, industrial, or residential. REITs are required to distribute the majority of their income to unit holders. Canadian REITs currently yield approximately 4% to 7%, depending on the specific REIT and sector. A $200,000 investment in a diversified Canadian REIT portfolio at 5% yield generates approximately $10,000 per year, $833 per month. Fully passive. No tenants, no maintenance, no management decisions. Tradable immediately. Inside a TFSA, tax-free. Option 5, Dividend ETF. Genuinely passive, instant diversification. A dividend-focused ETF like VDY, Vanguard FTSE Canadian High Dividend Yield ETF, holds a diversified basket of high-dividend Canadian stocks at a 0.22% MER. Current yield approximately 4% to 5%. A $200,000 investment generates approximately $8,000 to $10,000 per year, $667 to $833 per month. One purchase, globally diversified or Canadian concentrated, depending on the ETF. Entirely passive. Here is the vault, the genuinely achievable version of passive income on a normal Canadian income, with the specific capital target and timeline that makes it real rather than aspirational. The realistic first milestone, $500 per month in passive dividend income, $500 per month from dividends at 4% yield requires $150,000 invested. This is not $1.2 million. It is $150,000. Achievable within a reasonable time horizon for a Canadian earning a median income who invests consistently. The timeline at different monthly contribution amounts, invested in a 7% total return portfolio, 4% yield plus 3% growth. But here is the critical addition. The passive income grows after the milestone is reached. Because the dividends from the $150,000 portfolio are being reinvested, DRIP, and the monthly contributions continue, the portfolio does not stop at $150,000. What $500 per month in contributions looks like continuing past the $150,000 milestone. By year 20, from a standing start at $500 per month, approximately $260,000 to $10,400 per year, $867 per month in passive income. By year 25, approximately $346,000 to $13,840 per year, $1,153 per month in passive income. By year 30, approximately $453,000 to $18,120 per year, $1,510 per month in passive income, $1,510 per month in passive dividend income from $500 per month contributions over 30 years. This is the achievable version. Not $10,000 a month while you sleep in 12 months, but $1,500 a month by retirement from a contribution that fits within a median Canadian income. And that grows every year as the dividend growth compounds on top of the reinvestment. The Canadian TFSA advantage on top of this. Every dollar of those dividends inside a TFSA is entirely tax-free. The $1,510 per month is the after-tax amount. There is no income tax, no capital gains tax, no OAS clawback impact. The $1,510 stays with you completely. Understanding what passive income actually requires does not prevent every mistake. Here are the 3 specific traps that derail most Canadians in the pursuit of it. Trap 1. Chasing yield instead of quality. The most common mistake in dividend investing specifically? Choosing the highest-yielding stocks rather than the highest-quality ones. A stock yielding 9% sounds dramatically better than one yielding 4%. But yields are high for a reason. Either the stock price has fallen, pushing the yield up, or the dividend is unsustainable at current levels. A dividend cut on a 9% yield stock often results in a 30% to 50% drop in the stock price simultaneously, destroying capital and income at the same time. The investor who chased 9% yields ends up with 0% yield and a much smaller portfolio. Quality first, sustainable payout ratio, consistent earnings, pricing power, dividend growth history. Yield is a result of quality, not a substitute for it. Trap 2. Starting a passive income business instead of building passive income assets. Many Canadians spend years building content platforms, e-commerce businesses, or courses under the passive income label while neglecting the only thing that creates genuine passive income: invested capital. The opportunity cost of spending 5 years building a dropshipping business that generates inconsistent income and consumes 20 hours per week versus spending 5 years building a dividend portfolio is often enormous. Both are valid paths. Only one is genuinely passive. Trap 3. Taking dividends as cash during the accumulation phase. Covered in the DRIP video, but worth naming here specifically in the passive income context. Taking dividends as cash during the wealth-building years before the income is needed is the single most effective way to slow the path to meaningful passive income. Every dividend reinvested is compounding at the total return rate. Every dividend taken as cash is the passenger falling asleep at the wheel of their own compounding engine. Drive on. Always. Until you actually need the income. Here is the honest framework, not a course, not a system, a specific sequence of decisions that builds toward real, genuine, sustainable passive income inside the Canadian tax structure. Phase 1. Clear the high-cost debt, if any. Any credit card balance at 20% is a guaranteed minus 20% drag on everything else. Until it is gone, any passive income built is being partially eroded by the interest cost on the other side of the ledger. Clear it first. Phase 2. Build the emergency fund. 3 months of essential expenses in a competitive HISA. Until this exists, any market downturn can force you to sell your passive income assets at the worst time. The emergency fund is what allows the passive income portfolio to stay invested through downturns. Phase 3. Open a TFSA at a discount brokerage, Questrade, or Wealth Simple. Specifically, a self-directed TFSA, not a TFSA savings account at a bank, which pays a savings rate and does not allow investments in dividend stocks or ETFs. Phase 4. Choose your passive income vehicle. For most Canadians, the most accessible starting point is a dividend-focused ETF, like VDY, Vanguard FTSE Canadian High Dividend Yield ETF, approximately 4 to 5% yield, 0.22% MER, or a diversified all-in-one ETF like XEQT, lower yield but better long-run total return through growth. For Canadians closer to the income phase, within 10 years of needing the money, a dividend-focused portfolio makes more sense. For Canadians in the long accumulation phase, 20-plus years, the total return of a growth-oriented ETF will likely produce more passive income eventually through a larger capital base. Phase 5. Enable DRIP and automate contributions. Set up automatic monthly contributions on payday. Enable DRIP on every position. Leave it alone. Review once a year. Do not check it every day. Phase 6. When you need the income, turn DRIP off. This is the transition from accumulation to distribution. When you actually need the cash flow, you disable DRIP and let the dividends flow to your account as usable income. This is what the portfolio was always building toward. The honest timeline summary. From $0 to $500 per month in genuine passive income on $500 per month of contributions, approximately 14 years. From $0 to $1,000 per month, approximately 20 years. These are not fast, but they are real, and they compound, meaning the income at year 25 and year 30 is dramatically higher than at year 14. The patience required is the entire point. Passive income is not a shortcut. It is the output of sustained, boring, automatic investment discipline over a long period of time. Let's come back to where we started. $1,200,000 to generate $4,000 per month in passive dividend income. That number is accurate. It is also not where you start. It is where the compounding eventually takes a consistent investor. $300,000 for $1,000 per month. $150,000 for $500 per month. These are the achievable milestones, the ones with specific timelines. 14 years from $0 at $500 per month of contributions to the first $500 per month of passive income. 30 years from $0 to $1,510 per month. Not 12 months, not a course, not a system. 14 years of $500 per month contributions, and DRIP-enabled and a self-directed TFSA holding quality dividend-paying assets. This is boring. It is also the one version of passive income that is actually passive, where the income genuinely arrives without you doing anything, from real businesses that have been paying and growing their dividends for decades. The passive income content tells you what is possible without telling you what it takes. This video told you both. The first part is inspiring. The second part is what actually gets you there.